Donald Trump had an absolutely brilliant move, something we've been calling for here at Markowski Investments for 30 years when it comes to quarterly earnings. He said companies should no longer be required to report their earnings on a quarterly basis. Fantastic. Again, it's going to change things up, I'm sure. I'm sure a lot of the trading firms out there, and I'm sure Wall Street as well. They like the quarter. They like the news because you got to trade on this stuff. Their algorithms love this stuff. They're able to make all sorts of money. But I think it's great. He says that companies should report their earnings every 6 months. He said this will save money and allow managers to focus on properly running their companies. SEC would have to approve of this. Since 1970, publicly traded companies have been required to submit quarterly earnings report. Again, he's doing it every 6 months. As far as I'm concerned, that's a start. I would make it yearly. Number of publicly traded companies in the United States, and we've talked about this here on the program when we're talking about valuation in the market. You've got a lot of money chasing fewer companies that trade public. It's about 3,700 companies. That's down 17% from just 3 years ago. That's about half of what it was back in 1997. We talked about this. And again, every single thing that has transpired, we called. Let's go back in time. We go back to the .com collapse and Enron and WorldCom and all this stuff. And of course, we public demands something, and government's got to grab their torches and pitchforks along with the public and do something stupid. This was in the early days of we can go actually talk about it, in regards to the Bush years. Very early, we had Sarbanes-Oxley. Now, again, prior to that, right before Bill Clinton was leaving office, they repealed the Glass-Steagall Act, which allowed for corporate and commercial banks to come together, and we had these big financial supermarkets. Okay, .com collapse. Again, got to do something to fix it. They come up with Sarbanes-Oxley, and we called it. We said the amount of regulations that were involved, you're going to see fewer companies going public here in the United States. They're making it too difficult, and that's exactly what's happened. Then again, okay, Wall Street's got to jigger up some other type of scam. So again, we had mortgage-backed securities, put that on steroids, financial crisis, crash, bang, boom, Dodd-Frank. More regulations, thousands and thousands and thousands of pages. Again, basically wiped out a lot of mid to smaller banks around the country. Why? Well, regulations made it too expensive for them to do business. Do you understand? You're getting some sort of, you seen a pattern here when it comes to regulations and what it does? Isn't it amazing how regulations, if crafted properly, will protect the elites, insulate the elites? It's called regulatory capture, and that's what we've dealt with. Also, you talk about double the amount of publicly traded companies back since 1997. Guess what? You could have gotten involved at a much lower price. Now you deal with these IPOs that we've talked about here on the program, where basically by the time they go public, they're raising a little bit of money for operations, but all they're doing is getting the insiders out. Not the way things are supposed to work at all. But again, I like this move by Donald Trump. You eliminate some of this, you might entice more companies to go public. Again, we've got a very, very small market. Just think about it. 3,700 publicly traded companies in the United States of America. It's not that much. You actually think about it. WatchDog and WallStreet.com.